Hello, welcome to Valuation Summer 2019 Part 2 for Financial Statement Analysis. Just as a reminder that valuation is the process of determining the economic value, intrinsic value of a business or a company. It reflects the performance of the historical performance of the company, plus its expectation of the future performance, which you have computed based on a series of assumptions. Oftentimes, we start with this analytical approach, this objective analysis, but the transaction itself is finalized at the negotiation price at which the seller is willing to sell and the buyer is willing to buy. That's true no matter what type of decision you're making. We talked about the major categories of equity valuation models, and in part 1, we talked about present value models. In this section, we're going to talk about multiplier models and asset-based valuation models. Some of the popular price multiples that we can use to determine value are price to earnings, PE ratio. That is probably the most common one. It does depend on the industry in which you're doing business. It can be price to book, price to sales price, price to cash flow. That's an interesting one. It's sort of a blend of earnings, but also taking into account the quality of the financial statements, and the real underlying purpose is to generate cash. Just to go back for a review for you, PE ratio is the price of stock divided by the earnings per share. We generally express it as 2 decimal points, and the resulting quotient is saying for every $1 in earnings, how much is the market valuing the company? So if the PE is 5, the market is paying $5 for every dollar of earning. That's the premise that over time that will continue to generate an income stream for you. Well, there's a lot of different valuations that'll be based on future earnings. And we have 2 basic types of PE that we use. A trailing PE, 12 months trailing EPS, TTM, and a forward PE computed on estimated earnings. And that's the estimated earnings are what you're going to compute, and we've talked about in the forecasting side. Now, when we look at this, next one to look at is what's called enterprise value multiples. And this is trying to see what the company is worth, and it takes into account what the market actually perceives today and what the EBITDA is for the company. So it starts with market capitalization, which is the number of shares outstanding times the share price. Market value of preferred is the same. Many companies don't have it. Market value of debt, we could be fancy, but today I would just use for everything I'm doing and you would be doing, we assume that market value equals book value. There may be some that's cheaper, there may not be, but at this point we're just going to make an assumption on that one. Less cash and equivalents gives the enterprise value. This is how much the company is worth. Okay, because if you're thinking about the value of the stock and the debt, if you take out the cash, what's left over is everything else. And you divide that number by EBITDA, and you get the economic value divided by the EBITDA. Now, many investors use this to determine whether a company is undervalued or overvalued. But you always need a comparison, if you will, because it varies based on industry. If we look at the broad S&P index, it's averaged 11 to 14 over the last few years. Okay, and again, as a function of leverage and valuation. The average last year at this time was 12.98. Generally, it's an EV to EBITDA value below 10 is commonly interpreted as healthy and above average. Now, with that being said, it's reasonable to expect higher enterprise multiples in high growth industries, okay, because the company is growing, those expectations are higher, and lower multiples in slower industries, slow growth. A low ratio indicates the company may be undervalued. May. This becomes an important concept because it could be a loser company. The company could be indicative that the company is running into problems. The market is perceiving that. And a high ratio may indicate that a company is overvalued. Here's an example. We'll talk about this in a moment. Is a capital cube, which we can get through the Wall Street Journal. I'll show you how to do that. This is Steel Dynamics, and this is the peer group. So we can compare their EV, EBITDA, to the market, the peer median peer group, and see that they're probably fairly close. When we look at the PE, we also see they're pretty close. But what we can see is that from 2015, we've had a deterioration in both the EV to EBITDA and the price to earning. There's different methods of comparable. We can look at them over time, or we can look at them as cross-sectional. What that means is we're going to compare them within the company to the past or average values, or we're going to compare them to a benchmark or peer group. And what's the justification? We can use these together with the discounted cash flow. The fundamentals or cash flow predictions give us a discounted cash flow model, and then when we look at what the multiples are, we can see where we are in relative terms. How do we know if we're right? I don't know. The outcome of our value and the work that we're doing is based on our and your historical analysis. What you saw, what I saw, and the set of assumptions that we make about what may happen in the future. Okay? So there's some variation here that is expected. Now, different analysts may have a different set of assumption and use different methods than we did. They may have more sources of information, have much more complex models that we do, have done this multiple times. I think if you followed along with everything we're doing, your skills relative to the whole financial statement analysis have progressed amazingly. So at that point, we keep refining that. So we need to take that into account. It all comes back to your assumptions. Let's just interject a little bit here. Analyst research. We have sell-side research, and these are people who follow a list of companies. They build models to project results. They speak with customers, suppliers, competitors, everybody to get a sense of what's going on about a company. They have an expert network. They talk to people in the supply chain, the customer marketing, all over. They come up with financial estimates, price targets, and recommendation. They are trying to drive business to the firm, convince institutional accounts to the trading desk, try to generate more income. They want to differentiate themselves, but they want to create value. Now, these are done by investment banks, whether that be JP Morgan, Morgan Stanley, Credit Suisse, Deutsche Bank, Citi, Barclays, Merrill Lynch, Societe Generale, and tons of second-tier banks that are all trying to drive business to the firm. Then we have buy-side research, and they do the same things, except they want to be right. And they can work for institutional investors, paid research, or the work that any one of us do. So everything we are doing today, we're looking at it from a buy-side perspective, okay? Because we're not trying to drive business. Examples of this is we have the Cleveland Research Company, Sabrient, CFR, which used to be the old S&P, Thomson Reuters, Morningstar, IHS Markit. So these are buy-side analysts. You buy their information. They work to help. They take a little different perspective, and sometimes they're much more critical than sell-side analysts. Brokerage houses in the Wall Street Journal aggregate research and can provide industry comparisons. Let's take a brief look at what we can find at the Wall Street Journal. So let's see exactly what's going on at the Wall Street Journal. You can go in and you can search, and you don't need a subscription to do some of this. And I'm going to, of course, put in STLD, because that's the company I've been working on. And what comes up is a couple of things here. One, we have a picture of the company from what the stock price closed at, what was the range during the day, what's the... So here we see Steel Dynamics. We can see what the closing price was as of Friday the 14th. We can see the one-day range and the 52-week range. We have a chart, which we'll come back to shortly. So what you have is you have, on this page, you have news about the company, key stock data, what the PE ratio is, earnings per share, market cap. We then have a list of competitors. Now, every different, you can come up with either very narrow lists when you try to match up what the company does, a smaller peer group, or you have a bigger peer group. And if we look at this, where do we get this information? We could add these all up and average them. We could weight them. We could also just click down on information from Capital Cube. And what it will tell us is it will do a couple of things here. Is it will talk about here's the peers, but they'll also do a peer analysis if we look. So this takes all of the PE ratios that we talked about and shows the peer group median compared to the company. And you should be able to find that, use this information to evaluate your valuation that you're going to be doing in in SRP 3. Now, when we keep going, we can see that it gives us an earnings estimate, talks about its financials. I want to just go back where it says more information. And what we can see is the analysts. Right now, there's 14 people covering it. And 8 say buy, 1 say overweight, 5 hold. When we go back just a month ago, we had 12 and 4. They've dropped out. 1 has gotten more bullish in an overweight. 1 has gotten a little more bearish to an underweight. They've identified price targets right here. So if you look, these 14 firms are saying they expect a target price of the next year between 27 and 47 with a median of 35 and an average of 35.67. So based on the current price and what these analysts are saying, we may perceive that it's undervalued. What we also can get here is earnings per share estimates. We can do them quarterly or we can do them annually. So this also might be something I might want to compare my company. What did I come up with earnings per share to here? Are they reasonable? Okay. And by reasonable, I mean for the first quarter 2020, 324. Now, if my earnings come out at $8 a share, I'm missing something. But if I'm in this range here of earnings per share, that's telling me I did a fairly good job. You don't want to back into it, but it gives us guidance and something we can check on. The next thing I want to take a look at is, and we're going to go to advanced charting, we're going to go to advanced charting where this is a chart, and what it has is this line here is telling us what the closing price was on each of these days. Where did it close? And we can see that it closes at 27.10 on the 29th. Let's just take it right over here. That as of June 13th, it closed at 26.67. I have 2 other lines here. And the lines, if we're looking at it, that black line that's solid is the 50-day moving average. That's the moving average of the closing prices. And the 200-day moving average is the same thing based on the price over 200 days. So what it does is gives us a trend. And what we're looking at here is we're seeing the trend. The 50-day is below the 200-day, and it's trending down. So we would say the technicals aren't very good. Now, we put this on a 5-year, and we get a very different story when we look at it over 5 years. What we see is that it has been from, we go back here, through January of 16, it has been above the 50-day until we got to December of 2018. Bounced back up, dropped it back down in April, and hasn't yet recovered. So we're looking for trends. So in this case, we look at a 50-day moving average and a 200. We want to see data points over the 50-day because that's indicating an upward trend. This is a downward trend. Again, depending on how you do it, you look at it over 2 years, we see that it's dropping. And over a short period of time, we've seen that the data points for the past year probably have started to trend down. So that's some of the stuff we can find here in the Wall Street Journal. The last piece we're going to use is asset-based valuation. And asset-based valuation is not as commonly used. It's more situational. And that is when you're not really buying the going concern, you're buying certain assets that you put a certain value to them. So you start out, we got the book value of assets and liabilities. So what you do is you estimate, you go through a process or processes to estimate the value of what each of those assets and liabilities are. So you take everything apart and assign a value to it. Okay, so you're going to take cash, what the value of receivables are, inventory is, equipment is, and a lot of times equipment in property, plant, and equipment is going to be worth more than it's on the books for. Okay, or it could be worth less. And what happens then is you get the market value by valuing the assets. When we use asset-based valuation, we tend to use it in what we'll call liquidation situations or in distress situations. And the potential problems are difficulties in determining what fair value is of some of these. Oftentimes we have book value that differs significantly from the market values, and then we have intangibles. Take a look at Kraft Heinz and you'll get a sense of that. We can also be in a hyper or rapidly rising inflation environment, such as we've seen in some of the Latin American and Asian countries. So that's our asset-based valuation. Basically, you just need to know what it is. We won't be looking at that. When we look at some of the pros and cons, the advantages and disadvantages, the present value models are appealing, and it's a direct computation. We can understand it. The input uncertainty, the uncertainty of the assumptions can lead to sometimes misleading estimates of value. On the multiplier models, they're easy to compute and analysis is easy. Problem is computing a peer group or comparables. But then again, it doesn't necessarily look at what the underlying potential is. It uses existing historical multipliers. Now, we could do a earnings forecast and compute them that way also. Asset-based valuation is used when it's consistent with the notion that a business is worth more than the sum of the parts. Difficulties being determining market value and the value of intangibles. And I think if we look at these two, and really there's some rationale for using them, if you have a company that's had steady growth and we can estimate sales, the discounted cash flow method can work. It's ideal for some of the parts worth more. Available of data and deep understanding of the company, input, output, and dynamics, as we've done with strategies. We need a couple of things there. You can read them. On the earnings multiple, it's a check on the DCF. So if you think about, we're going to come up with a DCF, these multiples are going to be that check. Okay? And it goes a little deeper than just using a typical PE, because it sometimes includes market sentiment, what the market thinks may happen. So that's sort of the rationale for using these two as we move forward. But keep in mind that it's a check on the DCF. Advantages and disadvantages, I'm going to go through these fairly quickly. Theoretically correct, takes growth and change into account. It entails a deep understanding of the company. It's fundamentals driven. That's what we've been spending the past few weeks actually studying. The drawback that it doesn't pick up the moods or sentiment within the market. It can be long and hard to calculate. Okay? It requires a deep understanding of the company. If you don't understand the company, a deep understanding, you won't be able to do this. There's a lot of estimates that go into this. Your weighted average cost of capital, sales. We're not looking at beta right now, but that's another methodology. Market cap, easy to quick and dirty. Okay, but that doesn't capture the intrinsic value. Okay, there may be a gap. Earnings multiple, comparable peer groups. This is probably one of the most common methods. It's easy to obtain, quick and dirty. And the market, in reality, determines if something's worth. Comparabilities rarely exist. You have to make a series of assumptions on what companies. It doesn't account for growth, strategy, change. It doesn't. It's purely mathematical. It doesn't look at the future, which we do in the discounted cash flow. That's why it's sort of a check to see if we're in range. Liquidation value, accurate in the short term, easy to relate to. But it doesn't take into account growth. The whole may be more valuable than the parts. You may leave money on the table. Option models, which we're not going to get into, are there. They're very interesting in publicly held companies when we can value companies based on prices of options, but it's a market-driven thing as opposed to one based on the growth and the strategy that the discounted cash flow model does.